I'm Roger Montgomery from Montgomery Investment Management. Almost 30 years ago in the mid-1990s, a now retired fund manager gave me a tip for what he described as an easy way to make money in the Australian stock market. And given how tough even professional investors are finding the market at present, I thought I'd offer a little early Christmas cheer and share that tip with you today. Now, before you get too excited, however, keep in mind this isn't a get-rich-quick idea. I'm not suggesting anything algorithmic like arbitraging futures and ETFs on the same underlying index or anything like that. Instead, what I'm about to suggest is a repeatable way to invest in a sector of the Australian stock market that appears to have provided excellent returns to those who have applied it in the past. When it comes to consumer discretionary retailers, it's easy to think high risk, especially when they're on the nose as they are now, thanks to rising interest rates, higher inflation, rising fuel and utility costs which are eroding the share of wallet that consumers can spend on discretionary goods. But identifying the retail concepts that are popular and will expand is one of the simplest pieces of due diligence that can be conducted, especially when a company is IPOing. As you'll see in a moment, it can also be very lucrative. My preference is for the company to expand through organic sales growth and store growth. And as you'll see, store growth ambitions for discretionary retailers are usually disclosed in the IPO prospectus, and within 12 months of float, you commonly have a good idea about management's ability to deliver and the customer's affection for the concept. Take a look at Lovisa. 10 years ago in 2012, Lovisa sold its fashion jewellery products through 60 stores. At its IPO in 2014, it had grown to 220 stores. That's just 2 years later. And today, just 8 years after listing, Lovisa distributes its jewellery through 449 stores. Now look at the share price performance. Since it listed, the share price is 976% higher. That's a compound return of almost 35% per year. And by the way, that's after the rout in markets investors in companies other than Lovisa have recently experienced. Next, let's take a look at JB Hi-Fi. It's a retail concept everyone knows. Those brightly coloured window and in-store signage shout bargain, and shoppers have supported the concept for more than 2 decades as the offer shifted from vinyl records to CDs to DVDs and then to a broad range of electrical goods. JB IPO'd in October 2003 with just 25 stores. It issued shares at $1.55. On the first day of trading, those shares closed 45% higher at $2.25. And today, with 316 stores, including Clive Anthony's and Good Guys, the shares trade at $43. That's a return of 2,692% or 45% per annum, excluding dividends. And finally, Nick Scali, the furniture retailer made famous by current CEO Anthony Scali. It IPO'd 9 years ago in May 2004. At the time of its full year result that year, it reported sales of $43.4 million and earnings of $6.7 million from just 10 stores. The IPO price was $1. With 85 Nick Scali stores today and more than 90 plush stores, the share price is up 940%. At $9.40. And at the peak of the market boom last year with the shares at $16, the share price return was 1,600% or something approximating 37% per annum, excluding dividends. Markets and share prices wax and wane on the back of a multitude of influences that often have little to do with the underlying businesses they represent. I trust you'll agree it's much easier to stomach those sometimes spine-tingling swings when you're on a winning retail concept rolling out stores at a great rate of knots. That's all we've got time for. I look forward to talking to you again next week, and in the meantime, please follow us on Facebook and Twitter.